Take a look at this dual-axis chart mapping out the last couple of years for the software giant, NICE. On the left, we see total revenue climbing steadily, bringing in close to $3 billion. But look at the valuation line. Despite those record earnings, the stock shed over 40% of its value. That collapse maps directly onto a phenomenon investors started calling the SaaSpocalypse. The market panicked that generative AI was going to completely commoditize traditional software-as-a-service business models, rendering legacy platforms irrelevant. The fear was that the heavy on-premise infrastructure holding these older models together was turning into dead weight, making it impossible to keep up with agile AI startups. This disconnect created a massive trust deficit with institutional investors. While the stock was sliding, former executives were still pulling in tens of millions in compensation, frustrating shareholders who were left holding the bag. Going into the first quarter of 2026, the company faces a strict mandate. They must prove their AI infrastructure produces a clear competitive advantage before the market writes off the legacy brand entirely. To fund that survival strategy, leadership is carving up the company. They are currently negotiating the sale of their highly profitable financial crime division, Actimize, expecting to pull in around $2.5 billion. That cash is needed because they just spent nearly $1 billion to acquire Cognigy, a German firm specializing in conversational AI. This chart outlines expectations for their first quarter earnings report, showing a clear split. Legacy product revenue is contracting, projected to drop 16% to $28 million. Meanwhile, cloud revenue is surging by 15%, pushing past previous quarters to hit $602 million. They are intentionally cannibalizing their own traditional software business. It's a calculated move to shed outdated contracts and force a complete transition into a pure-play AI company. We are already seeing this technology integrate into physical healthcare settings. The company recently announced a native integration with Epic's electronic health record system. This relies on what is called agentic AI, meaning the software is autonomous enough to directly access a medical workstation and execute patient service workflows, like appointment scheduling and follow-up care, without requiring a human administrator to click the buttons. This level of enterprise adoption is expected to push Q1 global revenue to roughly $761 million. Regionally, European, Middle Eastern, and African markets are projected to jump by 18.5%, while the Asia-Pacific region charts a 16.5% increase. After seeing these deals close, the market is starting to respond. The stock recently recorded an 11% jump in a single day. Autonomous utility is the direct catalyst for this international revenue rebound. These organizations are deploying software that executes specific, high-value tasks independently. The board of directors is reinforcing this momentum with capital. They recently authorized a new share buyback program to repurchase $600 million of their stock. That represents almost 9.6% of the entire company. Buying back that much volume sends a clear, aggressive signal to Wall Street that leadership believes the current share price is deeply undervalued. The final test comes down to corporate governance. On May 28th, shareholders will convene for a special general meeting to vote on a new structure for leadership alignment. This chart breaks down the proposed pay framework for new CEO Scott Russell. It caps his guaranteed base salary at $900,000, while ensuring that at least half of his annual equity awards are entirely performance-based. To actually earn those equity units, Russell has to clear steep hurdles. The payout is directly tied to specific benchmarks for revenue growth, operating income, and how well the stock performs relative to the broader software index. They are systematically selling off their legacy assets, allocating billions toward agentic AI, and chaining their executive wealth directly to shareholder returns. Taken together, this Q1 execution serves as a definitive blueprint for how a legacy tech giant survives the AI revolution.